If you have shares in any of the big Nigerian banks or you're an investor in any of their stocks, this particular video is for you because there is something the central bank is about to do that will affect all the banks, especially the big holdcos, and also affect their investors. But we are here to explain these things to you like the way you understand it. Welcome to Clockwise. This is where we stay far ahead of the happenings in the stock market. Now, we'll be discussing something very crucial today, and I'll not be doing that alone. I have my guest that I say he sleeps on the charts and he also sleeps on the fundamentals of this company, and he'll be giving us a in-depth analysis of what is about to happen to the banking stocks and the banking sector in Nigeria. Now, with a resounding virtual round of applause, welcome, Mr. Kane. Welcome to Clockwise.
Thank you very much for having me.
Yeah, welcome. I think that, was it last year? We thought we've seen it all when it comes to the CBN policies about the banks in Nigeria. Now, we have seen an exposure draft. Although they say it's a draft, it will not be implemented now. Maybe they have from now till 9th of July for stakeholders' deliberation. But there's something so spectacular about this proposal. There are some things that I feel will not just affect the bank positively, but in the long run, it also affects these banks negatively. Now, first of all, let's look at what they are trying to do. We have this analogy where we have these holdcos. They have subsidiaries under them. Let's say, for instance, GTCO has different GT banks as a subsidiary under them. Now, we also have another example where this particular subsidiary also have other subsidiaries under them also. Now, it's like a parent, children, and grandchildren. But the central bank is saying, no, we don't want that, should I say, that relationship any longer again, where the grandchildren are answerable to the parents and the parents are answerable to the grandparents. Instead, we want the grandparents to be in charge of the grandchildren and leaving the parents to stay independent. I don't know if the analogy actually joins it.
Works.
Now, what do you see about this?
Okay, thank you very much. So, 10th of June, we had that announcement made for holding companies, new guidelines for holding companies, which, if I'm to maybe speak a little bit, you mentioned short term, it could have benefit, long term, no. It's actually short term, long term it will have benefit. Short term, your short term it might have some downsides. And we've already seen the downsides. Look at the sell-off we've seen so far. Very sharp sell-off. With some like weekly, GTCO has done is down almost 7%. Access Bank is down. You have Facebook down over 6% for each of them. So what that tells you, and by the way, I'm gonna tell you why they are down later. But that's a short-term pain, but for long-term benefit. So what is this guideline? The guideline has to do with the way holdcos work. Like you mentioned, you rightly gave the analogy. Holdcos work. You have banks, you have insurance, you have pensions, you have capital, asset management, and all of those things come under one. Sometimes you even have payment gateways. Some banks have payment gateways as part of it. Now that holds what we call a contagion risk. What do we mean by contagion risk? It means that if one of those subsidiaries is affected badly, there is a way or in which it can actually spread out to other subsidiaries. So the CBN says, no, we should not have that. We should have a way of unbundling everything and ensuring that, I mean, because again, if something happens, you might not really be able to tell something that happens to the subsidiaries because it could be covered up, but CBN says no, they don't want that to happen. So they had 4 specific guidelines that they put forward. We have what we call the surcharge capital requirement, which, for example, says that the whole co must have a minimum of 20%, at least 20% capital above the minimum regulatory capital of all the subsidiaries. So, for example, let us say a holdco has a bank has 20 billion in minimum regulatory capital. Then it has insurance, 20 billion. I'm just using this as a hypothetical case.
That's 40
20 billion. Then it has an insurance, that's a bank, and insurance, 20 billion. Asset management, 20 billion.
60 billion.
Pension, 20 billion.
80 billion.
That's 80 billion. So what that means is, okay, let me, for purpose of mathematics, let's say all of them have 25 billion, 25 billion, 25, so you have a total of 100 billion. The rule says that the whole co must have at least
20%.
A capital of 120 billion.
That is 20% above
the
total,
combined, yes.
Okay.
So that is exactly what that particular rule says.
What would that imply to these subsidiaries? How do you think that will affect the subsidiary?
So what that means is that it will lead to a lot of capital raising. Which is where I was going to, and which is why you see some of the banks selling off. Because, like you see, First Holdco actually did right each issue. They might even have to do more in order to meet up with this. So that fear that different banks would do capital raises is why some of the banks are selling off. Because something that also introduced is that for most of these institutions, for example, it introduces that independent standing.
Yeah.
So what that means is that excessive capital on one. For example, if I have excessive capital, like what I told you, 100 a bit, good. If I have one of them has, let's say 30 or 40 billion, and the other guy has 10 billion, normally the regulatory capital should be what? 25 billion. But it has only, let's say, 10 billion. But another of, let's say the bank, instead of having 25 billion, has up to 40 billion. That's 15 more. Now, so if you add that 40 to the 10, it gives what? 50. Which compensates for, which means that the bank plus insurance give 50 billion, which is combined, that's the minimum capital requirement. But this rule says no, that if the bank has 40 billion, that is the bank's 40 billion. The insurance has to, if the insurance is supposed to have 25 billion, it has to raise 25 billion. It has to raise an additional 15 billion on its own. So you see, that is why investors believe that this would have that effect, that most of these subsidiaries would have to go to the market to raise money. And they would do public offers, write issues and all of that. So, of course, when you do those things to incentivize people to come out, to want to bring their money, you have to give at a discount. And that's why, if you look at some of these holdcos are coming down. Look at CBN, First Holdco just did a right issue at 16 naira. When the stock was trading at 73. As I speak with you, it's trading at 61 naira. So you see, that premium has actually died out because investors try to price this in. So that's why you see it has downward impact pressure on stock prices.
All right.
So that would be one of the proposal. The other one is actually ownership, and that says that the whole course must have a minimum of 51% ownership in all the subsidiaries, meaning that the whole co must be unequivocally the majority shareholders in all of the subsidiaries.
I kind of align with that particular, because you see a situation where holdcos will just have a small percent in a particular small company. They will use their big name to cover up every other inadequacies of the company, and investors will just come and invest in it.
That's why the bank want to. It's what we call risk, contagion risk. Is a bank's desire to manage the risk of a contagion risk, which means something happens in one part of the system and spreads quickly to other parts of the system. So they say 51%. But beyond even the 51%, it means that even in the ownership structure, it's now a standalone. For example, the Nigerian bank Nigerian banks have subsidiaries, like you said, grandfather, grandparents, parents, grandchildren. No. What you should have is even the Nigerian bank subsidiaries should stand alone. So, for example, you have First Bank in Nigeria, you have First Bank, for example, in Kenya. the first bank in Kenya should report directly, should be administered directly by the what?
The whole code.
By the whole code.
Okay. Not the first bank.
So that because what tends to happen is, if first bank in Kenya is suffering some kind of liquidity crunch, then the first bank in Nigeria will do what? By the way, effectively the deposits of Nigerians will be used to bail out that bank in Kenya. So you have those systemic risks fly unnoticed. The bank is saying, the CBN is saying, if you are suffering, suffer alone. Carry your cross alone, straight, so it doesn't touch someone else. So that's what it is. So that's the ownership structure. Then even in registration, everything has to be standalone. The subsidiaries of the holdco have to report directly to the holdco, not bundled together.
Yeah.
The subsidiaries of banks, for example, when the subsidiary of a subsidiary has to report directly to the holdco, so that allows
the banks to be on their own.
The banks to be on their own.
The government can face the bank.
It's about, like I said, it's about protecting depositors. Because, like I told you the last time, when it comes to shareholders and depositors, the bank, the CBN, always prioritizes depositors
than shareholders.
Shareholders are here to make money. They're not here but these other people, that's their life savings. And you have to put trust in public financial institutions. It's very important, because if anything happens, if a contagion risk happens, you don't want to have to deal with a bank run. Even healthy banks will be affected. Remember, banks operate what we call there's what we call cash reserve ratio, which means banks don't hold exactly. If I deposit 100 naira or 1,000 naira in the bank won't hold that 100 naira. So, like, for example, we have a 40% cash reserve ratio. That means a bank should hold 40% of that money and then lend out 60%. So the idea is that everybody cannot come at the same time to ask for their money.
Yeah, it's true.
Yes. Rather, the idea is that, let's say 40% of the people come to show up to ask for their money, then we can give them. However, when there is a contagion risk, a systemic risk, and people's confidence in the banking system is threatened, guess what? Everybody rushes. So instead of that 40%, even if you have 45% of the people, the chances of you, and with all these impairment charges, like you saw what happened with Access Core, you realize that that means that a lot of bad debts are sitting unaccounted for. These debts, these loans, are actually people's deposits. Yeah. So imagine if those people show up to get their money back, the bank would not have, and that will lead to a systemic risk and a bank run. So that is what the bank is trying to.
The CBN
is trying to prevent. Now another thing is kind of reinforcing the structure itself, wherein the holdco cannot intervene in the credit system of a bank, credit approvals, for example, of a bank. And as a matter of fact, if the subsidiaries loan or lend money to the holdco, it has to be treated as a capital deduction on the holdco
by the CBN.
In that arrangement, really, meaning that before now you say, okay, Chairman, just help me. Just give me. But on the books, nothing has changed. Just give me some money. Don't worry, I will give you later. It has to reflect in the as a capital deduction. That is for purpose of thorough accountability and to ensure that the CBN knows exactly what is going on. The position of in terms of the cash position of or capital position of the holdcos. So it's a way of introducing more transparency into the holdcos and ensuring that they are accountable, because a lot of things happen fly under the radar. And before, if you look at even the 2008 financial crisis, we had a lot of poor performing mortgage-backed securities that banks were packaging and selling. Yeah. And that, because it was not monitored, guess what? It caused a systemic risk, which actually brought a lot of banks, including Lehman Brothers and all of that. So we don't want the same thing to happen. The CBN is trying to work proactively to ensure that those things don't happen. But you can't really know when holdcos know how to pad everything and ensure that everything looks as clean as it could be. So that is exactly why you see this lending requirement. There are a few other things that the CBN has talked about, which is also very important, which is particularly about operational independence. Risk management has to be handled at the bank level, at the individual level, subsidiary level, not the whole co. You come to the whole co and say, how are you guys doing? You say, I'm fine. And then you walk away. No. The question should be, how are the whole co's doing? And when you do, you're performing risk management, you don't perform risk management of the whole, because when you do the whole co comprises a bank. There are different
insurance.
The banks that have different risk management parameters. Insurance different.
Asset
management different. Pension, but you are but you are categorizing all of them under one umbrella, and you're using one streamlined approach to manage risk. No. When you do that, you would have ignored some of the risk peculiar to some of the subsidiary.
Okay.
So the bank says, no, you cannot do that anymore. Risk management has to happen
individually
at that level. And then compliance itself, CBN, compliance itself has to be done by the CBN itself.
Oh, no more one thing single.
No. It has to be done by the CBN. So the CBN will regulate the insurance part of the whole co. They will regulate the bank. They will regulate the capital market, the capital arm, asset management arm. They will regulate the pension arm. Now, but what happens? This is the fear. Is that most of these institutions will now pull out of the whole co.
That's one thing I want to ask.
Yes, they will pull out of the whole co because, you want to. That is obviously what is being feared, that they will pull out of the whole co. So, I remember you asked short-term, long-term. Short-term we have already seen.
Yeah.
From an investor's angle, investors are more like they fear dilution coming with capital raises. Most of these guys will go to because again, like the proverbial saying, the wind will blow and the earners of the chicken will be exposed. So what do you think they will do? Most likely they will go to the capital market to raise more capital. And raising more capital, there's a fear of dilution for existing investors. Some of them want to sell off, wait until when those guys come in with when they come in with those offers, they buy. Because, for example, if you had bought into First Bank when it was trading at 70 something, now a rights issue showed up at 60. If you had sold there and bought again, you would buy more shares. Now, it's one of the reasons why I said, I remember when I didn't really know that this was coming. I just spoke technically. When there was someone on the channel that was saying, when you guys are saying for this GTCO will come down, when is it coming down? And so that we can buy. I said it will come down, but I spoke purely from technical because I know that when you see a chart and then you see imbalances, there's always a 70 to 80% chance that those imbalances will be filled. Good. And this has happened. Sometimes technicals, fundamentals seem to play into technicals, to prove. So that's why some people can actually work with just purely technicals and they will be successful in the market. But though we try to balance both of them because, again, it also allows you to know why what you're seeing on the charts are happening.
Correct, yeah.
Now, First Holdco has sold off. Access has sold off. Access is now back down to, in fact, Access is now 5% year to date. Just so you know, it had gone as much as 60%. At a certain point in this year, it actually went to as much as 60% year to date, 60% in terms of the upside. But as I speak with you now, because of this regulatory framework we are expecting, the bank has sold off to 5% year to date, and that is a very attractive point. It's back down to 22.95.
Okay.
I had told you in a previous podcast that my sweet spot is where 20 to 22. So it's coming into my sweet spot. That's where most of my limit orders are kept. Okay. So as it comes in, it will trigger those limit orders and then I move it. I remember when that video came out, when we made that video, and then the price came down to 23 and then we bounced back up to 26. Someone said, maybe your price will not be. I just knew that it will come in. So it's actually there. Even GTCO was at some point, it was as high as 104% in terms of gains, stock price gains. But now it is now back to 154.55% year to date. That's like literally more than half of the percent of the year gains. So it's an opportunity for you to accumulate. Then for First Holdco is now down. You ready? By 5%. 5% year to date. That's a very attractive position for you to get into First Holdco. So most of these names are very attractive. Most of these holdcos are very attractive. And I still expect, like I told you, for First Holdco is still at 22.95. I expect it to come down because my limit order is between 20. And why do I do 20? Because that's the last rights issue was at 20. So I'm looking at 20 to 22. That's why I'm entering. That for me, I know that, I mean, you have a different opinion, but for me...
That's why I want you to talk, because I know what you're saying.
No, that for me is a buying opportunity. I'm an investor. I'm a value investor. A value investor seeks for dislocations. Remember when I talked about this channel, I've been saying, keep dry powder for market dislocations.
Yes.
I'm already invested in this name, just so you know.
You even said something. You said liquidity is a position.
It's a position. No, cash is a position.
Sorry, cash is a position.
Yes. I'm already, just so you know, I'm already in this name, because some people will say you are shielding, you are talking down this name so that it will come down for you to buy it. No, I already have position in all of the focus.
In all of this.
But like I told you, my point is, what is the average buy price? So that's why when I enter a position, I leave liquidity, I leave cash, and I keep on, I ladder in. For example, when it gets to 21, I'm going to buy in again. But when it gets to 20, I will do some of my biggest purchases at that point. So that my average buy price will be somewhere around 2021 and all of that. But because I know that these banks, this policy is actually to strengthen these institutions and to restore public confidence, not just within Nigeria, but outside Nigeria. Foreign investors are looking at some of these things. When a bank becomes almost very resilient, because this is supposed to make the bank to be very resilient. When a bank becomes very resilient, investors are more comfortable, are more confident to allocate to those banks. Remember, by September, Nigeria will be where? Into the FTSE Russell Frontier Market Index. That brings public attention, international, global attention to the Nigerian market. What? S&P Global says from B- to what? To B+ because of the stability of our exchange rates. These things attract investors. But I told you, and I'm going to say again, if there's any sector of the Nigerian economy that is very regulated, that extremely regulated, is the financial space. That's why you see a lot of investment coming to financial space. And how do you position? You have to position yourself. So you have to consider every dislocation in this particular space as a buying opportunity. So for me, it's the right point for Access. Access, I still have positions down there up onto 20. For First Holdco, I still have positions. It's 61. Now, by the way, the last rights issue was at what? 60 naira. So that means it's literally 1%, one naira above the rights issue. So I'm literally buying more like an existing shareholder. Because that was my existing shareholder, who were shareholders as of April. I already had position stocks, but I'm saying even if I'm buying as a new shareholder, I'm literally buying at the price that the other people bought, the shareholders bought back when they did the right issue. And then you look at the likes of First Holdco, 60, Access Bank was 20, the last right issue 20, and it's trading at 22 now. Then you have GTCO. Yeah, GTCO is 54 year to date. But you see, I expect the further downdraft. But even at that, I am buying at a very good price. Okay. It traded as high as over 100% year to date. Now it's down to 54. That's for me even from technical analysis. When you talk about premium pricing and discount pricing, anything below 50%. From the all-time high is what? It's a premium pricing.
Now,
It's a discounted pricing.
before we go, I'd like to give you your flowers because you talked about Access Bank, and I said it was a penny stocks. That was some few weeks ago. I think this particular policy is bringing everybody together at the same level.
Not, but if you observe, over the past several weeks, Access Bank has been the least beaten down.
We're already down.
Okay, because they're already down. But what does that tell you? It tells me that capital depreciation in terms of for holding Access Bank is the least among all of the FUGAs. So if I'm a guy that is interested in capital preservation, I think I would have fared best with Access Bank than any of the other FUGAs.
Okay.
And I still believe that when it comes to the upside, Access Bank we could see GT is currently at 126. I would not be surprised to see a GT under $100,
okay.
100 naira. But Access Bank would have to be a black swan event for Access Bank to dip below 20. If you look at even the chart, you see that 20 seems to be such a support level. Okay. So I think, it's our opportunity. I would tell viewers, start to allocate. If you are not allocated to these names, forget about the fact someone said his portfolio is consistently red. Yes, the reason is obvious. Banks are going to be, because of this new policy, banks are going to do a lot of capital.
There's a season for redness.
This is season for and by the way, remember I said even before this was issued, I said in May, in one of the videos, that June is going to be a down month.
It's always a season for redness. It is a red season.
It is a red season. And I remember someone told me dividends are going to be paid. So why do you say it's a down month? It's going to be a down month because Nigerians are driven by any calls.
Now, if it was a football match, I would have said this is the season for Manchester United. This is a season for the Reds.
Are you trying to push your club side out there? So the point is, nobody should panic. If this was something, if you have been following this channel, you realize we had said this over and over again, that it's going to be a red month. Right. But what is a red month? I always said what? I said, you have to be comfortable and be in the market to buy when there's blood on the street, including your own blood. Do you think I'm not down on my positions on the focus? I'm down. But guess what? I am buying more.
It's a good
because when you buy at these prices, and even they go lower, I will still buy. It's because it allows a good entry. It allows a good average entry price. Okay. And whatever you call profit is based on the entry price.
All right. Thank you very much. You've done justice to the conversation.
Thank you.
Thank you for coming again.
Thank
you very much. If you are not in our Telegram channel, our Telegram group, you are actually missing a lot. Now, we have a community where most of our viewers, most of our subscribers are there, and they interact with us on a very close range. We also drop updates on when we go live on this channel, so you can ask us live questions on the comment section and we respond real time to you. So there's a link on our profile page. If you go there now, you see a Telegram link that can bring you straight to our community where you can have updated real-time information, because most times it takes time to edit these videos, and before you get to see them, most times the event must have passed. So for you to have real-time information, you have to be on the Telegram channel, on our Telegram group. We'll have real-time conversation and real information. Now that's been our package for today. Please do not forget to like, subscribe, and put on the notification bell on this channel. Also share to your friends, because this is where we stay far ahead of the happenings in the stock market. My name is Providence, and I want you to always remember there is always a bull market somewhere, and we are here to help you find it. See you again.